Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is bonds payable according to the USGAAP. If you want to know about bonds payable according to International Accounting or IFRS, we have a video about that, and the video is in our video description. Usually, we have two, or the most common type of bonds are premium and discount bonds. And why do we have it? Because fair value of a bond changes when market interest rates change. Market value of a fixed rate investment moves in the opposite direction of the market rates of interest. If our interest rate is greater than market rate, we are giving our buyers, we are giving them a premium. So the market rate is 5, we are giving them 6. So we are giving 1% premium. On the other hand, if the interest rate is lower than market rate, for instance, market rate is 5, but we are giving them only 4. So they are giving us a discount. So we have a discount bounce. So let's see how it works. Let's go to our Excel file. And all our Excel files, they are free, and the link to download it is in our video description. We will not be focusing on this video about how to find the carrying value and so on. If you want to know more about that, we have a video on it, bonds, and where we focus on this calculation. And this video is also in our video description. So let's go on. First, a premium on bonds. Because why it's premium? Because the market rate is 5, our bond rate is 6. So we are giving them 1% premium. So our cash, 315. Our bonds payable, we will pay after 6 semesters, $300,000. And we receive now 3,015. So the number to balance it is our premium on bonds payable. So we need a credit here, $15,000. So our premium on bonds payable, 15. And this is our amortization schedule. Cash interest, how much we will be paying, interest expense, how much our interest expense, and the amortization of our premium. So after each semester, what we will be doing? Debit interest expense, 15. Credit cash, 18. The difference, the number to balance it, we need a debit to balance it. 18 less 15. It is our premium amortized. So debit premium on bonds payable. And if we double check here, those numbers must match. Okay, and then after each semester, we would be doing these amounts here. At the end of our 6th semester, we close our premium on bonds payable. And then at, at maturity dates, we pay it. So debit bonds payable, $300,000, credit cash, $300,000. Okay, guys? What about a discount? So let's change here to be the same as yours. Our bond rate remains 6. However, and when we have the same number for bond and market rate, we have no premium or discount. The face value will be the same number as the carrying value. So let's consider now our market rate is 8%. So we have a discount here. What is the journal entry? Cash, 272. Bonds payable is our future value. uh, is our face value or future value, 300. Now we need a debit to balance it. 300,000 less 272. So we have here debit 27. And after each semester, interest expense 21. We pay cash 18. Now we need a credit to balance this guy here, to balance this journal entry. So credit 3.7 thousand dollars, and our discount is going down because we need to close this after the sixth semester. So after the other semesters, and also why I'm doing that, because the same, this discount here must match the discount amortized in our amortization schedule. So here 4,000, 440, and let's copy and paste here. We have nothing. We close the discount on bonds payable. And at maturity date, bonds payable 300, cash 300. We also close the bonds payable. Okay, guys, please subscribe our channel. It's very important to us, and you will be the first one to know when a new video arrives. And like our Facebook page, Accounting Hub by Dr. Scarpin on Facebook. And if you have questions or comments, leave it here or email me at jscarpin@gmail.com. Have a very nice day and God bless you.